Hi everyone, it's Chris here, and today is Thursday the 23rd of September 2010, and I'm going to comment on the apparent housing bubble in Australia. Now, on my way home this evening, I picked up my daily copy of the Financial Review, and on the front cover there's an article on the housing bubble in this country. Or to be more specific, the Reserve Bank of Australia rejecting the notion of a housing bubble existing in Australia. Now, this article came about because there appears to be many foreign investors who are very concerned about the high prices of real estate in this country, and so they should be. And I've maintained for the last 3 or 4 years now that we are indeed experiencing a housing bubble in Australia. Now, the point of this video blog is to provide a very simple and brief overview from an Austrian economics perspective as to why we have a housing bubble in this country, on what causes asset bubbles, and we'll look at things from a historical perspective as well. But first, we must define what constitutes an asset bubble. Well, to put it in real layman's terms, I think we can define it as a substantial increase in the price of an asset or asset class when compared to its sort of long-term trend or average in terms of growth. So, for example, if house prices or property prices in Australia on average over 100 years increase by 3 to 5% a year, roughly in line with inflation, and then all of a sudden over the course of a few years you have house prices doubling, then this would constitute a property bubble. And what we've seen in Australia over the last 10 years is property prices increased by over 100%. And in many cases prices have doubled, depending on the area, over a very short period of time. And this isn't sustainable, it's not normal, it's not natural. You've got blocks of land where there's been no tangible value added to this land or increase, and the prices of this land have doubled over a very short period of time. As well with property, as well with houses. There's been no tangible difference to the property, however prices have doubled, just magically like that. So what the Austrians maintain is this: that asset bubbles are created by a substantial increase in the supply of money, thanks to credit expansion. Now, we can look to history for examples of this. We can go back to the Roman Empire with coin clipping. We can go to the Netherlands with the tulip mania, where the government policy of free coinage increased the supply of money substantially. The Netherlands was somewhat of, I guess, an economic powerhouse. They traded with many nations. The Dutch East India Company had a monopoly on trade with Japan. They imported a lot of silver from Japan, a lot of bullion and silver from the US, bullion from Spain. They robbed many Portuguese boats as well, I think over 300, and acquired a lot of silver and bullion that way also. And thanks to the free coinage policy, this exponentially increased the money supply, and the historical data shows this to be the case. And what this meant was that money flowed into asset classes. In this case, it was the tulip bulbs, and thanks to speculation also, it created this huge bubble in tulip bulbs, where people were putting the whole life savings into these tulip bulbs. It's just ridiculous. And what happened was when the government repealed this free coinage policy, that's when we saw this tulip bulb mania implode. Now, we can look at the 1980s as well in Japan, where the central bank monetary policy was very relaxed. We had interest rates fall to artificially low levels. We had, therefore, a huge increase in the supply of money. And this meant that the share market became extremely overvalued. Money flew into the share market. Property also was extremely overvalued. And eventually, there was a bust there also when they started tightening monetary policy. And then we can look at, in the more recent history, the US with the housing crisis they've had there. The Federal Reserve Bank in the US reduced interest rates in 2001, I think January of 2001, from 6.5% to 1% by mid-2003. And this created a huge housing bubble. There was a huge increase in the supply of money, and eventually that bubble crashed also. A big part of this, you might be asking, where does this money come from? Where does this money supply come from? Well, money is created due to the fractional reserve banking system. So what happens is, essentially, to put it in very simple terms, is for every dollar that's in reserve or deposit that a bank has, they can lend out another $8, $9, $10 or $11 against that dollar. and that's fractional reserve banking. So for example, if I borrow $100,000 from my bank, and then I buy an asset of some sort, then that company deposits my check for $100,000. Money's come to existence out of a lesser amount of money. That's essentially in a nutshell. So that's what's happened in Australia also. So with the housing bubble here, what has happened is, and what's fueled it, and why we're in a bubble, is that the Reserve Bank of Australia has reduced interest rates to artificially low levels. Okay, so the federal or the reserve fund rate has been reduced to artificially low levels, which in turn has meant that commercial lending rates have been reduced to artificially low levels. And these low rates have caused borrowing and lending to explode, and particularly in relation to the real estate industry. And all these low interest rates had to be also extended to people with, poorer credit, or people that wouldn't have normally received loans. So therefore you've had more people in the housing market further bidding up the prices of houses, people that wouldn't have normally been granted these loans. So that's what's happened in Australia. We've had an increase in the supply of money here also. And this is the case that can be seen throughout history, okay? So that's what's happened here. Now there are a lot of people, well, before I move ahead, the Austrian view on interest rates is this. We believe that interest rates should be determined by the amount of savings. So for example, as savings increase, interest rates should fall. And what this does, it sends a signal to businesses that people are saving consumption from now for a later date, okay? So consumers are saving consumption for a later date, which is good. Business can afford to invest, and they're encouraged to invest due to these low interest rates. And then they can take part in economic growth and invest in capital, etc. Now what happens is, when central banks and the Reserve Bank of Australia can arbitrarily reduce or increase interest rates, you send mixed signals to the businesses, okay? And this in turn creates malinvestments. And so what happens is, when central banks reduce interest rates to artificially low levels, you have money flowing to an asset class from productive, parts of the economy to, non-wealth generating parts of the economy, i.e. the real estate market. And you create a big bubble. And then eventually when this bubble pops, you have a lot of unemployment, you have resources moving out of this industry, and ultimately, basically a recession in most cases sorts this problem out. And that's pretty much the cure to the problem. So that's what the Austrian perspective is on interest rates in very, very simple terms. I don't have the time to go through it in detail. Now, in Australia, you have, and around the world, you have a lot of market analysts and economists and people in the media, and they're saying, look, the problem here in Australia, why we have really high house prices, is that there's a shortage of houses. We have a supply issue. And to an extent, I would have to agree that's the case. But I believe the bigger problem is what's created this artificial demand, this excess demand that wasn't there before. It's this artificial demand that is the bigger problem, as opposed to the shortage of houses. There have been not enough houses. It's not like there's people everywhere sleeping on the streets or anything. You have people like David Bassanese, who's a market strategist and regular contributor to the Australian, or the Financial Review. He had an article in June of this year, June 19th. And he ended this article by saying, he ended it by saying that the only way house prices were going to fall due to these several factors. And pessimists like myself have to explain why these things would happen. And that is, quote, housing pessimists need to explain where new supply will come from and or why inflation and interest rates will surge, end quote. Now, to answer David there, well, we do have a shortage of houses, but the bigger problem is the artificial demand that's been created, that's created this shortage, okay? To try and put it into a really overly simple perspective is this. Imagine everyone tomorrow in Australia had $2 million, okay? I can guarantee that over the next few months, you're going to have a shortage of luxury cars, or BMWs, for example, in the showrooms, okay? Because you've had this artificial demand being created. So is it a case of BMW not being able to supply enough cars, or is the bigger issue here that there's been an artificial demand being created, okay? And I think this is basically what we can apply to the housing market. It's more of a demand issue an artificial demand that's been created by the Reserve Bank than anything else. Now, to get to David's point here of why inflation and interest rates will surge, well, for starters, we have price inflation, and it's in the housing market, and that's plain for everyone to see, okay? Because with this increased pool of money, we have inflation, price inflation occurring in the housing market. And in different times of history, it will be in different other asset markets, whether it be real estate or the share market. So we have inflation at the moment, David, and it's in the property market. Plus, we're also seeing prices rise, in other consumer goods as well. And at the moment, the Reserve Bank's trying to cover this up, and then they're blaming inflation on the mining industry and wages increasing there. And that's a very minor issue compared to the overall Reserve Bank policy in this country. So I disagree with these people that say there's a supply shortage. It's more to do with an artificial demand that's been created. And on top of that, when you ever have these bubbles, you have obviously a lot of speculators, and all investors are essentially speculators. I'm not denying that. But we have what I like to call B-grade speculators coming to the market. And these are all these people that wouldn't normally invest or analyze things too much. And what happens is they see all these magazines and the news age on housing and how you can't lose. You have all these TV shows, all their family and friends, everyone's jumping on board. This herd mentality comes into effect, and everyone's jumping onto the housing bandwagon. You can't lose, enter the market. And this further bids up the price of houses. So that's what's happening in Australia. And eventually it's going to come to an end as all asset bubbles eventually burst. And when they burst is when there's a contraction in terms of the growth of the supply of money. And when we'll see that in Australia is this. Now, I don't like to predict when things will happen because there are so many variables. But essentially what will happen is when rates go up another % or two, you're going to see house prices fall significantly. Now, there are a lot of people saying we're going to have a soft landing. And I can tell you now, we ain't going to have a soft landing. It never happens. When money flows out of an asset class, it flows out. The reason being that when investors and other people see that money is falling or asset prices are dropping, people tend to sit on the sidelines a bit more. People aren't going to rush in. It becomes a buyer's market. If house prices are falling, why would you, jump in straight away? You're going to see how far they fall, and you're going to bid extra hard or bargain extra hard. So that's why you're not going to have a plateau or leveling off or stabilizing of house prices. It's just not going to happen. And the Federal Reserve Bank, of course, they're never going to admit that they've caused this problem. They're going to blame it on mining, on other things. So that's why in regards to this article that I picked up today, they're rejecting the idea. They want to maintain confidence in the economy, and they'll always deny to the death that they played any role in this bubble. So that's my brief summary from an Austrian economics perspective and why we have a bubble in this country. If you'd like to view more resources on this topic, I encourage you to go to mises.org. That's www.mises.org, and you can search up, just type in the search into their inflation or monetary policy or asset bubbles, and you'll get a range of articles, and you can go into more detail in terms of learning about the Austrian perspective on different economic things. So thanks for watching this video blog, and I'll speak to you soon. Bye.